Good morning once again. Today we are going to talk about the preparation of how do we prepare profit and loss account to ascertain the profit or loss. And this is the format for profit and loss account preparation. What is the objective of preparing profit and loss account? To ascertain the business result. What is a result? A result can be profit or loss. To ascertain that, we have we have a format, a template. So this is the template. A template of profit and loss account has debit side as well as credit side. Now, what do you take on debit side? You take all expenses. Okay, and what do you take on credit side? You take all incomes. Now, when you take expenses, all these expenses are not related to workshop or shop floor or factory. All these expenses are incurred within the office. Okay, if you look at office salaries, it belongs to office, communication, travel, official office rent, or depreciation for office assets, audit fee, insurance, repairs and maintenance of office assets, selling and distribution expenses, advertising, salesman commission, delivery van expenses, and the depreciation on that, bad debts, financial expenses like interest, bank charges and bank interest. Okay, interest on loan, loss on sale of the assets. Now, apart from that, general administrative expenses. These are all expenses that you see in the office. Okay. Now, similarly, you can see the incomes. Now, here you will take incomes other than the sales. Why not sales? Why not sales? Because sales are already taken in the trading account. And the result of trading account is either profit, gross profit, or gross loss. Now, gross profit is the balancing figure you have seen in the trading account on the debit side. Balancing figure is on the debit side to the trading account. What does it mean? The trading account shows a credit balance. The excess of credit over the debit is gross profit. The excess of debit over the credit is gross loss. If it is gross loss, take on the debit side of the profit and loss account. If it is gross profit, take on the credit side of profit and loss account. Profit and loss account. Okay, right. Now, remember, you will start this profit and loss account either with gross profit or with gross loss. If you're starting with gross profit, okay, it is on the debit credit side. If you're starting with gross loss, you're starting with the debit side. Okay, right? If is gross loss, drop on the debit side as the first item. If you're starting with gross profit, drop the gross profit on the credit side as a first item. Okay, what is the first item in this example? Okay, which we are going to take. This is a case, gross profit. Okay, now we are going to start our problem with gross profit. Look at this. In the books of so and so, profit and loss account for the year ended 31st March 2013. If you don't write this, if you fail to write this heading, you will lose 1 mark, and the examiner can go up to 2 marks also. If you don't write the heading, the entire solution is right. Okay, look at this. It is like a man walking without a head. Imagine the whole body is functioning, the hands, limbs, everything is functioning. He's also able to walk, but he's without head. So it is like that for a problem. Okay, especially the balance sheet and the profit and loss account. A heading is important. Now, what do you write in the heading? In the books of the person, the trader, the company, in the books of XYZ Limited, in the books of Ravi Limited. in the books of let's say Joel Limited. So in the books of so and so company, and below that profit and loss account for the year ended so and so date you have to give. Sometimes 31st December, sometimes 31st March, whatever is the date. Okay, in India, the practice is to close the account on 31st of March every year. So for the year ended 31st March 2013. Do you understand? Heading is very important, right? And what should be the wordings for the heading? And these are the wordings that you have to meticulously, very religiously, strictly use. Profit and loss account for the year ended 31st March 2013, right? So having written this heading, we will go with the items. If it is expense, drop here. If it is income, drop here. If there's an outstanding expense, add that particular outstanding expense to the concerned expense. Okay, if it is prepaid, deduct from that concerned expense. Okay, now let's come to the case. Look at this. This is a problem. This is a problem. Okay, from the following particulars presented by Sri Tilankar for the year ended 31st March 2013, prepare profit and loss account. Okay, the first item, gross profit 1 lakh, rent 22,000, salaries 10,000, commission 12,000, insurance 8,000, and interest credit balance 6,000, bad debts 2,000, provision for bad debts 4,000, sundry debtors 40,000, discount 2,000, and plant and machinery 80,000. This is the problem. Okay. Now this is a calculations I have made. I'll explain you this. Now, in addition to this, you have adjustments given. This is called additional information. Additional information. Additional information. Now, what is this additional information? Outstanding salaries amounted to 4,000. Outstanding salaries 4,000. Now, what is outstanding salary? This is a word. Now, go to the trial balance and search for these words. Now, look at this. These are the balances given from the trial balance. Okay, trial balance. Now, in this, search for the adjustment item. Adjustment item 1 is outstanding salary amounted to 4,000. Come to this trial balance. Now, this is the abstract of the trial balance. Okay, so these are all items from the trial balance. Outstanding salary. Okay, salaries. This is what information given about salary. Salaries account shows 10,000. That is a summary of salary. Okay, but there's an adjustment. What is that? There's an outstanding salary of 4,000. So what do you do? What do you do? Okay, look at this. Profit and loss account debit to salaries. To salaries. Okay, 10,000. 10,000, right? This is what given in the trial balance. Add outstanding, there's an additional amount, 4,000. 14,000 is what taken in the amount column. This is about salary. And as I told you, what is the first item? Gross profit is the first item. Look at this. Gross profit is the first item. Gross profit 1 lakh. Okay, when we are starting, we start with gross profit by trading account in bracket gross profit, or you can also write by gross profit directly 1 lakh. Okay, 1 lakh. From there you will start. Okay, next, gross profit and salary are over. Now let us come to the next item. Rent paid for 11 months. Rent paid. Look at this. We can go in the order of these adjustments or in the order of the trial balance. Anyway, whichever way you're comfortable with. Now, why I took gross profit second time means because I'm going with this order: outstanding salary, rent paid for 12 months. This order I'm going. Okay. There's no hard and fast rule how you have to go. Okay. We can go with the trial balance order also. Let's say if it is trial balance order, first gross profit we take. Okay. By gross profit 1 lakh. Then next is salary. Okay. Rent rent 22,000. Okay, rent is an expense. Now if you see rent here, then you will come to the adjustments and check if there's any adjustment for rent paid for 11 months. What is that? This 22,000 is only for 11 months, but what we had to account for is for 12 months. Okay, if this 22,000 is for 11 months, okay, how much is for 12 months? If 11,000 rent is 22,000, how much rent is for 12 months? Okay, now the rent for 12 months is 22,000 into 12 by 11 gives you 24,000. So 24,000 is a rent for, it is a rent for 12 months. Rent for 12 months is, okay, 24,000, right? So 24,000 is the total rent due, but what is the rent paid? Only 22,000. So what we have to do? We have to add the outstanding rent. Look at this, profit and loss account, debit to rent 22,000, add outstanding 2,000. Okay, so 22 plus 2, 24,000. 24,000, right? This is how you're doing. You understand this? Any doubt here? Confusion?
No, sir.
Right. Next is, yeah, we are done with gross profit. Okay, rent, salary. Let's come to the commission. Commission credit. You know, commission credit balance means income. Commission debit balance means expense. Commission debit balance is what you paid. Commission credit balance is what you received. So that's 12,000. 12,000. What is that? Income. Now let us see if there are any adjustments for commission. Please scan through the adjustments. Okay. Commission. Number 1, 2, 3, 4, 5, 6, 7. Okay. Here is the commission. Commission received in advance amounted to 2,000. Okay. Now, please remember that either expense or income, you have to take, okay, whether it is income or expense, you have to take only the expenses or incomes belonging to this year, not the previous year, not the next year. So commission received in advance is 2,000. Means this belongs to the next accounting period, but you're receiving now. When you're receiving it now, what you should do? You should, come on, you should, yeah. Look at this. Commission received 12,000 less commission received in advance 2,000. This belongs to the next year. You have to deduct it. So 12 minus 2, 10,000 is the commission pertaining to the next year. Pertaining to the next year. Next, yeah, commission is over. Insurance. Insurance is 8,000. Insurance is 8,000. Okay. Now, any adjustment for insurance? Yeah, do you see any adjustment for insurance?
Yes, sir. Prepaid.
Yeah.
Prepaid insurance amount.
Insurance amounted to 2,000. This is prepaid. Okay, prepaid. What? Yes.
I just take a small question. In commissions, we are receiving it in advance, right? 2,000 rupees.
Yes.
We are given from the total amount of commissions received, right?
What? Can you be clear? We're not getting you properly. So insurance is 8,000. Okay, let's come to the adjustments. Is there any adjustment for insurance? Prepaid insurance amounted to 2,000. Okay, prepaid. Okay, insurance, is it an expense or income? Insurance premium paid is an expense for the company. So therefore debited. Insurance 8,000 less paid in advance of prepaid 2,000. So only 6,000 insurance premium paid is belonging to this year, right? What belongs to the next year, that is 2,000, is deducted, removed from the total insurance paid. This is the total insurance premium paid, but this 2,000 belongs to the next year. We will deduct so that we come to know the exact amount of insurance premium belonging to this year. Okay, next is interest. Interest 6,000. Credit, if it is debit, then it is expense. Because it is credit, it is income. Why? Income received. Okay, interest received 6,000. Interest received is 6,000. Any adjustment for interest? Any adjustment for interest? Interest due
Just you.
but not received. Interest is due but not received. Look at this. There is another 2,000 which is belonging to this year, but you have not considered that. What will you do? What do you do? Add. Okay, what is this interest received? Income. So take on the credit. Okay, take on the credit side. Interest 6,000 and interest is accrued but not received. 2,000 worth interest is accrued but it is not received. So therefore, outstanding interest, this is outstanding income. Add it, okay, to 6,000 so that it will become 8,000. 8,000. Okay. Next is yeah, interest is over. Bad debts. Bad debts 2,000. Bad debts 2,000. Okay. And what is this bad debt? I told you, right? I told you, right? Bad debt.
Yes, sir.
Yeah. What is irrecoverable debtors amount? That is bad debt. Okay. So bad debt is a loss. Debit all expenses and losses. Na? So therefore, profit and loss account is a nominal account. So debit all expenses and losses. This is a loss. So profit and loss account, debit to bad debt. Okay. Bad debt, 2,000. Is there any adjustment for bad debt? This is bad debt 2,000. Any adjustment for bad debt? Further bad debts amounted to 2,000. Further bad debts amounted to 2,000. This is an addition. So bad debt, bad debt 2,000. Add further bad debts. Additional bad debts. When you have started, it is 2,000. When you have calculated, it is 2,000. Another 2,000 became bad. Okay, so another 2,000. So the total amount of bad debts for the year is 4,000. Okay, 4,000. Let's come to the next item. Provision for bad debts, 4,000. Provision for bad debts, 4,000. And what is sundry debtors? 40,000 is the sundry debtors amount. So 4,000 in 40,000 is 10%, right? Right? So 10% is a provision for, 10% is the provision for bad debts. Okay. Provision for bad debts is 10%. 10% means 4,000 is 10% of 40,000 debtors. Okay. Now, let's come to adjustments. Any adjustments that you see about provision for bad debt? You see provision for bad debt? Yeah. Further bad debts amounted to 2,000. This is already done, right? and make a provision for bad debts at 5% on Sunday debtors. And look at this. You know, at times you will be given an additional provision to be made. If it is provision for bad debt, profit and loss account debit to provision for bad debt. But here it is deducted or reduced from 10%, the provision for bad debts became 5% on debtors. Look at this. It is like this. Where is this? Yeah, the debtors amount is, yeah, this is a working 40,000, right? And 10% of that is, okay, 10% of that is 10% of 10% of 40,000 is, okay, 40,000 is 4,000, okay, 4,000, right? Now 10% of that is 4,000, okay. Now this I'm just, no, this I'm just telling you just to keep in your mind and set it aside. Okay, let's come back. Debtors 40,000, okay, 40,000 less bad debts 2,000, okay, less bad debts 2,000, right? Bad debts, it's given here now, less bad debts 2,000, and how much is left over? 38,000. 38,000 net debtors, okay, net debtors 38,000. On this 38,000, what he says is make only 5%, not 10%, as you have seen in the trial balance. In the trial balance, the provision for bad debt is 10%, okay, on 40,000. Instead of doing that, okay, calculate only 5% on 38,000. How do you get this 38,000? 40,000 of debtors less bad debts of 2,000. Okay, you will have net debtors. Net debtors. Okay, and 5% of this is 1,900. 1,900. Okay, right. This is what we have done. You see disturbance, ma, lot of sound. You hear a lot.
Yes, sir. Now it is somewhat.
Right. Okay. So 19,000. Look at this. Provision for bad debt 4,000 less new provision at 5% on 38,000. Look at this. How do you get this? 40 minus 2,000, 38,000. On to 38,000, 5% is 1,900. Okay, 1,900. Look at this. Earlier you thought 4,000 provision for depreciation. Now they have given another condition. No, not 10%, which is 4,000, but make only 5% of the debtors, the net debtors. Okay, 5% on net debtors is 1,900. So 4,000 minus 1,900, 2,100. What is this 2,100? It is a gain. You thought the bad debt could be 4,000. You made a provision for bad debt 4,000. Now you are making only 1,900. What is this 2,100? This is your gain. This is your gain. Okay, 2,100. So debit all expenses and losses, credit all incomes and gains. This is not an income but a gain. Okay, therefore credited. Don't get confused. Okay, Ravi sir has shown the provision for bad debts on the credit side. I'm not taking provision for bad debt on the credit side. I'm taking only the gain on this reduction, right? Don't get confused. This is only gain on reduction. This 2,100 only gain I'm taking because it is coming down from 10% to 5%. There's a gain created. That gain I'm taking, but I'm not crediting the provision for bad debt. Okay, provision for bad debt is a loss to the company, which is debited. But here I'm taking on credit side just to show you this amount. Okay, is that clear? Right. Any doubt, please ask me. Yeah. Then provision for bad debt, 4,000. Sundry debtors. So what do we do with sundry debtors? Any idea? Sundry debtors are the customers to whom we have sold the goods on credit. We are to receive the amount. What we are supposed to receive is an asset for the company. When it is asset, you will take into the balance sheet in the list of assets, right? The next, discount received, 2,000. Discount received. Any adjustment for discount received? Discount received. Please check. Discount received.
No, sir.
No adjustment here. So directly you will take discount received, 2,000 as income. Discount received, income 2,000. Fine. Plant and machinery, 80,000. Plant and machinery, 80,000. Okay. Where do we take plant and machinery? Where do we take? Is it on debit or credit side?
Balance sheet, sir.
We neither take on debit or credit side. Okay, we take it in the balance sheet, but we take a depreciation of plant and machinery. Okay, we take a depreciation of plant and machinery. What is the depreciation? Yeah, depreciate the plant and machinery by 10%. Okay, 10% on what? 80,000. 10% on 80,000. So therefore 10% on 80,000 is 8,000. 8,000. Okay. Depreciation on plant and machinery, 10% on 80,000, 8,000. Right. So any more items left over? Scan through. Yeah. We are done with gross profit, rent, salaries, commission, insurance, interest, bad debt, provision for bad debt. Debtors, we don't take anywhere. Okay, we have used it only for calculation of provision for debtors, doubtful debts. Discount received we have taken. Plant and machinery we don't take, but 10% of that we take as depreciation as debit item. Okay, now outstanding we have taken, rent we have taken, interest we have taken, prepaid insurance we have taken, depreciation we have taken. Okay, bad debts change we have taken, provision for doubtful debts change we have taken, commission we have taken. We have taken every bit of the problem, right? Every.
Yes, sir.
So there's nothing left. So therefore, let's come and
Yeah.
calculate. The total of credit side is 1,22,100. So 1 plus 10, 110 plus 8, 118 plus 2, 120 plus 2, 122, 100, 122, 100. Okay. Now let's count the total of the debit side. So first is 24,000 plus 14,000, 38,000 plus 6,000, 44,000 plus 4,000, 48,000 plus 8,000, 56,000. So deduct 56,000 from 1,22,100 so that you get 66,100. What is the 66,100? This is to net profit. To net profit. Okay, all these items are to, all these items are by, and the last item that you get is to net profit. Okay, 66,100. If this amount is more than, the debit side amount is more than, total is more than credit side, then you will write here by net loss. By net loss. So this net profit is taken to the balance sheet and added to the capital, okay, in the balance sheet. If it is net loss, it is deducted from the capital in the balance sheet. Okay, yeah. Now we'll just wait here for the doubts. Yeah, somebody is raising the doubt.